why non-direct credit, so the credit system with the intermediation of banks is better. And this is because of their brokerage function. And the brokerage function we have been um, looking or focusing on three different aspects and blah blah. I won't hesitate more on that. You know, money and risk racetracks. We already saw direct and non-direct transfers. The three reasons: monitoring costs, liquidity costs, and price risk. Three reasons why direct credit is ineffective. This is related to the delegated monitoring function the depositors gave to the intermediaries. Diversification is also implied, and so on. And you remember the distinction between money, credit, and asymmetric information view I mentioned as being as having been the focus of literature of financial intermediary theory for many years. The brokerage function, you already saw this repackaging, we saw several times, many times also, by emphasizing the difference between banks and insurers. Banks transforming risks and insurers redistributing risks, or better, redistributing the bad outcome of risks or losses. More about specialness. We saw specialness. We went through specialness by referring to the informational cost, liquidity and price risk, transactional cost, maturity intermediation, and so on. There were some new concepts like which ones? Intergenerational wealth transfer and also denomination intermediation. We couldn't face in the past. All the others we have been trading with. So that was the definition of each. Monitoring costs, liquidity costs, substantial price risk. And then economies of scale, maturity intermediation, so risk transformation, you remember, and maturity transformation. This is what we are referring to. Monetary policy transmission. So the money being regulated by the central bank through monetary policy channels, credit allocation, intergenerational wealth transfer, payment services denomination. So briefly, again, economies of scale also in transaction, maturity intermediation, not only service to enterprises but also households, mortgage, they usually play a big role in whatever crisis, and in the big one they did. We'll see in a few minutes. Monetary policy transmission, you know how it works. I reminded you how to build the LM curve and how is that the central bank can regulate the can influence the equilibrium, the general equilibrium, and also the interest rates, of course, which is the primary goal of monetary authorities, to regulate the interest rate in order to push the economy when the business cycle is when we have a recession. I'm going fast because we saw everything. credit allocation according to the authorities' guidelines, because some sectors are privileged, so they are there is a favor for some sectors, so special conditions for some sectors. Intergenerational wealth transfer, this is especially, it happens especially, this is a function of financial institutions in general, but especially the insurers, of course, through life insurance policies. Payment services, denomination intermediation, you know what is it? What is it? Denomination intermediation, what is it? Let me check if you are listening or not, or if you are playing with mobile. We have a few of us, so you can probably, yeah. Yeah. Perfect. So they have budget enough. They have enough budget to manage to diversify, to to lower the incidence of information costs and so on. So a lot of advantages for them. Well, then we also we had um, I proposed you a lab about topic discussion before going on. Now we are in a condition to, yeah, people is waiting for this form, so I will give you this this evening, or I will give you this form to be filled in order to share um, the information needed, to give me the information needed. Let me now remember how it works, and then I will show the calendar again, and then the forms, and then I will forward these forms through WhatsApp. There was a guy in charge. Matteo is not here. Is maybe by remote. Is he connected? Mattia. Mattia. Yeah.
Yeah, I'm online.
Okay. So perfect. So you are in charge. So
Yeah, I know.
the adhesion is not compulsory, only recommended, because I think it's a great opportunity for you. For me also, I'm not Santa Claus, is because I can save time doing by like this. I give you 14 different topics. Having set up your own group, 4 people, no more, please. You choose 2 topics out of this 14, and each group has to discuss those topics, to present maybe with a PowerPoint, but not necessarily, it's up to you. And all the students who belong to the group are expected to speak. So they had to do something. So they had to work, hopefully, but I cannot check if you are working because of the information asymmetry. I don't know what you are doing at home, but in presence, you have to participate actively to the discussion. Um, at least 9, 10 topics should be covered, which means that I give you 14, but again, please do not concentrate, well, not please, please, yes, please, always please, but you cannot concentrate on just a few topics. The discussion replaces the intermediate test if and only if the completion is oral. So you can complete being interviewed, and it will happen. They were asking yesterday, the day before yesterday, it will happen on the official sessions. So in June, I don't remember when I place the which is the precise date, but we'll finish then. You'll finish then in that case. But you have a few more options, so you can also so that was the first one here. 1A, 1B, answering only a part. Usually I ask you to answer 2 questions out of 9, 9, 10, 12. I don't know. It depends on. I change every year. But in that case, you choose again. So again, your choice. You choose a couple of questions to answer, and um, you'll be all together. So people having discussed topics and people having discussed nothing who didn't discuss anything has to answer to all questions. You, if you discuss only 2 questions, and then I will correct. I will have a look, and I will in one or in a couple of days I will give you the final grade. And of course, you can accept or not. Up to you again. If you do not accept, you'll be interviewed on the whole program at the official sessions. No problem. If you are not satisfied with the result. Topics. These are the topics. Did I share the topics already? I mean, the slide on WhatsApp? I did? Okay, great. So you already know everything. Probably you are already choosing them. Did you? For instance, which is your topic? Which are your topic? With the numbers. 13? Yeah? Yeah, okay. It was just a curiosity. Which one for you? 27. Oh, 2 and 7. Okay. Okay. Yeah, 2, 7, 7. Ah, nice. Great. So, and you? Great. So, all different. Fantastic. For the moment. Okay, great. To apply and blah, blah, blah. You know the story. This is the calendar. Till now, till today. No. Yes, till today. Uh, yeah, first and second. So you have time to. We have the whole next week to to deal. Probably would not be sufficient. I'll try to manage to concentrate. Maybe I will deliver more through WhatsApp, which is not. Um, is easy for you, so you don't have to stay there, but you may receive. I will upload on the Moodle some more explanations about the maybe missing if I miss something. Now this is the scheme. You already have it. So yeah, this is the form. I'm not sure you. Yeah, you can see. It's out of focus. I don't know why. Anyway, the original is you can read well. What you have to do is just write down the name of the leader, so-called leader, so the people who has to play the role or or leader in a sense that I will link the group to that name. So when you interact, it will be useful, use the family name of the leader. Just because, so in that way, and also put it in the uh, files denomination so that I can immediately recognize which is the group involved. eh? Just for that. No privilege for the leader, just an additional task to interact with me. Then the other people here, and then 2 crosses on the topics you are choosing. Yeah? And I will give you this later. I will share through WhatsApp. Just one form per group, please. Don't send me more than 1. And then in any case, you have to go through Mattia for that. And this is the general one. I need just one of this, because this is a synopsis. So if, for instance, we have 6 groups, at the end, Mattia has to give me 6 plus 1 forms filled. This is the resume. So here I have the calendar already. So you see, after the 12th, the 13th, the 14th, and the other week, the week following, and then the name and the topic, chosen topic. So just one for the whole class, which means 6 group, for instance, that would be 24 people. I don't know if it will be enough, otherwise we will add the calendar, and just one here. And of course, this one, so the whole class form has to be consistent with the information you give me here. Yeah? So the same information has to be here. So if don't choose number 3 and number 8, number 3 and number 8, well, I'll find here number 3 and number 8, of course. Of course. Any question about that? No question. So now I already told you what we are going to discuss now. Specialness and regulation. Specialness, we know a lot about specialness. That's in the introduction of your book. Financial institutions, they receive special regulatory attention, and the reasons, which are the reasons? This is a typical question that I could propose to you during the exam. So why financial institutions receive special regulatory attention? You remember before, low regulation, they are free to do whatever they like. And this is convenient, it's profitable maybe, but it's not fair, it's unfair, it's not fair for investors, for consumers probably. So why a special regulation is needed apart from this what I'm saying about investors and consumers, so about the retail clients of financial institutions. Speaking about stability, for instance, financial stability. They need special regulatory attention because of the negative externalities of financial intermediaries failure. You remember, they do not fail usually, but when they fail, that's a problem indeed, because of the chain effects, because all intermediaries, they are linked, somehow linked, so that, you know, if one intermediary would fail, probably some other intermediaries would be in trouble. And we got a very significant, a very useful example at the beginning of the current crisis, the Ukrainian crisis, when the Sberbank Europe did fail, so that several branches were in trouble and they failed as well. Special services, because of the special services they provide, special services, special regulation. And also because they are in charge of very specific and very crucial functions, such as money supply transmission, credit allocation, payment services, etc. Every time I find in my slides, because not all those slides are new, I'm adding slides every year. I'm kicking off some and I'm including others to update. When I say, when I find the payment services as a crucial factor within as a crucial function, I always try to remind you that it is no more so crucial. It's still very important, but no more so crucial because of the, we'll see that, because of fintech, because of new technologies, and because of plastic money at the beginning, and then the phone, the internet, banking, and now many other financial innovations, blockchain, and so on. Sorry. So important features of regulatory policies, you see, don't pay attention now to this top right graph diagram. It will be clear soon what is it. Important features of regulatory policy: to protect ultimate sources and uses of savings, so to prevent unfair. You see, I told you before, it wouldn't be fair to leave intermediaries to do whatever they like. Unfair practices such as redlining and other discriminatory actions. You know what is it? Redlining. 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 Redlining means, well, it's disappearing. Nobody knows why, but it's appearing. I want to show you here. Redlining is the illegal practice of denying racial and ethnic minorities to access banking, insurance services, and so on. This is red line. Back. And the final goal of all this structured system to regulate the financial intermediaries, financial institutions in general, or financial intermediaries, is to ensure soundness of the economic system. And of course, as a consequence, to guarantee the growth, guarantee the stability, and guarantee prosperity, and so on. Which regulation for financial institutions? So let's have a look to regulation set for financial institutions. Assuming that there is do imagine the widest set of regulation for an economic system. Yeah, this is what I call the comprehensive regulation set. Then we have a special set, which is a special subset of that, which is the regulation for financial institutions. And within this corpus, we have several types of regulation. So we have the safety and soundness regulation. We have the monetary policy regulation. we have the protection regulation. We have to distinguish when we refer to protection regulation, we should distinguish between consumer and investors protection, because they are the first victims of malfunctioning of the financial system. You can imagine why. And we have credit allocation regulation. This is mainly referred to those privileges I was mentioning before. So in some sectors, the credit has to be allocated to according to special terms and conditions. And then the entry regulation. Entry regulation. All this is aimed to guarantee the soundness, like we saw before, and financial stability. Everything is designed for financial stability. And quite often it doesn't work, because periodically we are there and we are there to experience bad crisis. But you can imagine if that regulation was not there, if everybody was free to behave without any constraint. So why? What could happen otherwise? And sometimes does happen anyway. Now, I would go back to the global financial crisis to let you understand at the best, I hope, why this regulation, because of specialness, this regulation is very important. So, speaking about the global financial crisis, and you know that global financial crisis is the crisis 2007, 2008. I mention here two very specific factors, maybe having something to do with the global financial crisis. Can you guess why I'm mentioning this two, which is the impact of this phenomena? Well, the first one is not just a phenomenon. This is the worst outcome of a man-made risk. When we maybe I already told you that when we have to offer a taxonomy of risks, and we speak about the big risks, so the CAT risk, and CAT stands for catastrophic, so the big ones. We distinguish between natural and the man-made. And the man-made are both, well, for instance, terrorist attacks, or also, and much more frequently, hopefully, for instance, the disasters due to the anthropic behavior. So the British Petroleum, which is an example that I'm used to propose, and Fukushima or whatever, but also terrorist attacks. So Twin Towers attacks seems to be a factor which had a role in the global financial crisis. And also growing Chinese current account surplus and corresponding United States deficit. Global imbalances, so growing Chinese and, surplus and growing deficits in the United States. So tons of dollars flowing from the United States to China during 25 years, 25 years at that time, which is the common effect of both these circumstances and what? Keep in mind the monetary policy transmission channels. And the monetary policy transmission channel, the most important, through the what central bank does through open market operations. So when they buy securities or when they sell securities, they are taking off money from the market, or they are injecting money in the market for doing what? Yeah, to influence the interest rate. So did these factors also influence the interest rates? Starting from the first. Of course, the expansionary policies was exactly the consequence of, and why it was needed then? Why an expansionary policies was needed after the Twin Towers attack? To push the economy that was, it was a big disaster also by the psychological point of view, yeah? So nobody would invest anymore, nobody would consume anymore, and that was a big problem. Also, it was a big shock. A lot of people died, and in the Anglo-Saxon world, almost everybody has a life insurance policy, and the life insurance policy, that more and more, how many companies they were located in those skyscrapers. So also rich life insurance policy. So there was a big shock also for the insurance sector. So lowering the if you lower the interest rate, you get an expansionary monetary policy. That's a symptom. That's the instrument, not the symptom. That's the instrument of a monetary policies aimed to push the market. And what has to do this? Growing Chinese current account with the interest rates. If has something to do. But I think it does. Yeah, because the Chinese government so dollars, plenty of dollars. What to do with these dollars? Now it's changed a bit because now they are buying whatever after having both all the football teams, all the companies around Europe. They are buying They both half of the African continent, and they are buying everything. But at that time also, they had not so many alternatives because of the incredible amount of dollars they owned. Then also buy the United States debt, so treasury bonds and the other bonds issued by the United States government. So a huge increase in the demand of those securities, whose consequence of this increase is the lowering of interest rates, right? Right? Then also that was the time when, because of securitization and because of financial engineering and because of financialization and because of all these trends, because of the convergence between different functions played by different intermediaries. So banks starting to 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 behave like insurers somehow, insurers starting to behave like banks, and also uh, the search, the obsessive search for new and higher return risks. All these, uh, they were the so lower interest rates on one hand and increased sophistication of financial markets. They were both reasons for the global financial crisis. And how we could explain that? Well, probably uh, with uh, with an example, not an example, but with the subprime story. I need the whiteboard for that. So stop sharing this. Jamboard. This is financial institutions management. 1, 2, 3. 3. Yeah. Share screen. Share. Okay. Sharing. So the topic is global financial crisis. We have the United States on one hand. We have China on the other hand. And United States are leading. Uh, I mean that uh, what happens in the United States impacts on many other countries. So European countries as first, and not just the European countries, So for many the factors we saw before for many years, um, dollars, a lot of dollars were flowing in this direction. Because of the current surplus. And then the consequence of the big shock and of this flows and the circumstance that China had to buy bonds, so lowering the interest rates, the consequence, if we imagine that this is the business cycle of the United States, and this is as a consequence our business cycle, let's say, like this. It's not exactly like this, yeah, but we may imagine. What happens on September 11? Well, happens something like this. So it was needed to recover, and the way that they could recover was to increase, you know the story because I showed you, increase the money and to decrease then the interest rates. Because if you increase the interest rate, the investments, they diminish. If you decrease the interest rate, the investments increase, then the aggregate demand increase as well, and so on. You know, this is the effect of monetary policy. So what happens when the interest rate decrease, and also when through this, for instance, open market operation, the central bank is trying to decrease interest rates, then is this while this surplus is still increasing. What happens? That is it's easier to get credit from the banks because banks are they also are dollars plenty, and they don't know they cannot manage, they don't know how to, you know, that's the reason why central bank was doing that. So to inject money in the system, uh, it happens that also mortgage would increase. And mortgage, exactly like all the other loans, because they are loans, of course, had to be granted to individuals having an adequate merit. So they had to be in a condition, they had to be, they had to be capable to give back the money they are granted. So there was a tendency to lend money also to borrowers, um, whose credit worthiness was not adequate. So what did happen? That, many houses were both in this way and for each of them there was a mortgage, and this, for instance, is this position, this risk is a risk, is a credit. The credit risk coming from this position is the risk related to an individual loan, of course. Whereas this instead is the risk related to a portfolio of loans. So we can imagine that this is part of the balance sheet of a bank. Yeah, we don't have enough room here. This is the balance sheet of a bank. And on the asset side, we have this loans, and this is one of the portfolios. Yeah. So what happens? That some of them uh, were not in a condition where shouldn't have been granted that loans, because they are not the possibility, they cannot repay. This, for instance. So one or two of them, yeah, this is a position defaulting when they are 1, 2, 3, 4, 5, 6, 7, 8, 9. Let's add another because it's easier for me. Still, the recovery rate here would be 90%. This is physiological. It's even a good result, a very good result. But let's imagine that in that condition, instead, we have several. So also this and this. Now the portfolio risk is increasing dramatically in this situation. Now, what happens now? According to what we have been studying, it happens that time is flowing, and banks do realize that the expected loss on that portfolio is not this one, but it's higher and higher. And it's approaching that tail is approaching that threshold, this one, over which they would fade. So what they do, this is the chapter 10 of your book, Individual Loans Risk. This is the chapter 11, Portfolio Risk. What happens? That bank does realize that the situation is increasingly difficult, dangerous. So that's time, because it's something that they know since the 80s, that's time to securitize this portfolio. So it's too risky. This portfolio is becoming a portfolio of bad loans, bad loans. So through an SPV, a special purpose vehicle, this risk is given to the market. And how is given to the market? It's given to the market uh, building new assets, the asset asset-backed securities where the assets backing the securities are these ones. Now, you probably you remember, or you know, or you have heard about the involvement, the responsibility of rating societies on 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 the outcome of the subprime crisis. Uh, these asset-backed securities were rated uh, because of the asymmetric information, because the investors uh, had no, you remember what we have been dealing with over the last 2 weeks. They were not in a condition to evaluate the risk because of the asymmetric information, because they do not have the expertise, they don't have experience, technologies, and so on, so they cannot evaluate. Because of the asymmetric information, they were given to the investors, having repackaged them. And repackaged means that this bank, in its role of originator, uh, and with the help of special purpose vehicle, have built a series of CDOs, so collateralized debt obligation, which means more or less means asset-backed securities. So what is a collateralized debt obligation? Is it's a basket where a series of risks are concentrated by an originator. These risks are, for instance, they can be loans, they can be ordinary loans, they can be mortgage, they can be credits coming from credit cards, whatever. And these loans, in spite of being bad loans here, good and bad, they are the bad loans here concentrated. They are still producing some revenues. So this is a CDO, this one. You have some protection sellers. And here you have the originator, and the originator is a protection buyer. So these revenues from from those positions, from those bad loans in this example, are still uh, producing some revenues, and these are the revenues on which they are betting the protection sellers, right? So what happens here when the number of positions is starting to be, they are starting to be too many, so that the whole portfolio is going to collapse, that also CDOs are going to collapse. And CDOs and CDOs of CDOs, so CDOs made having as ingredients, instead of just the bad loans, bad CDOs. So you see, what did happen is that when these positions they started to be, they had to be cancelled, the recovery rate went down dramatically to 0.2, 0.1, and the whole system could collapse. So let's see better. I did on whiteboard because it's better probably to follow step by step, but I have some slides on that, so I want also to show slides. Yeah. There are pieces of a famous, a very famous slide that you can find and download uh, from the web, but I'm sharing this so you don't need. And it explains the theory of how the financial system created best rated assets from subprime mortgage. Subprime. So subprime means uh, uh, mortgage whose creditworthiness was not adequate, like I said before. Triple A rated assets are the most valuable. You know why? You know the story. You know what are the ratings? And this is what's happened exactly like in my picture. You see, RMBS means residential mortgage-backed securities. So you have here a series of pools made by including them the positions that I told you before. You see, some of these houses are red, and red means they are positions going in default. People all over the country, the United States is the country, take out mortgage because of low interest rates. Financial institutions, they start to be scared because they smell that something is not going at the best. And they concentrate hundreds of subprime mortgages into mortgage-backed securities. So the outcome, those asset-backed securities we were speaking before. This is the scheme. The securities are grouped into tranches. So you have different levels of seniority so that as first is paid back the senior tranche, so the highest, with the ones with the higher privilege, so was to be paid first. So those securities, asset-backed securities, labeled like triple A. Then, if anything would, you know, would, if there is enough money, enough revenues from those critical positions also the other tranches are satisfied in the order. So A, B, 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 and so on. This is the structure. Higher rated bonds are the first to be paid each month, or no, not necessarily in the month. And you see here, the houses are whole black. So and you have this tranches are whole solvent, full. But the situation is not necessarily like this. On the right hand, you see it's different, for instance, because there is, in the first case, there is enough money coming back from those critical positions, enough money just to pay the senior tranche. And in the second, not even, because of the number of positions, of critical positions. Mortgage payments collected by financial institutions and payment distributed to bond holders, to this asset-backed securities holders. Higher rated tranches are paid first. And so this is the whole picture. The whole picture. And what you see here, bottom left, is a CDO made with CDOs instead of individual loans, some of them being critical and solvent. So you can understand there is no limit to the engineering of these products. So the asset baking, the assets baking this kind of securities are the individual loan position at the beginning, and then they are CDO, then they are CDOs of CDOs, and of course, the transparency level is decreasing. You cannot anymore guess how is the situation, how is the real recovery probability of your investment, because at any round you are suffering from additional asymmetric information. So that was more or less the reason why the Twin Towers attack and the hegemony of China. Well, the hegemony of China is not exactly like this, but and the let's say the persistent surplus of China and the uncontrolled policies of the United States. You know, United States, they do more or less whatever they like, and we suffer from consequences of that. I won't and I cannot comment on that's happening right now because I wouldn't finish on newspapers. But you can imagine what I'm referring to. So they are imposing sanctions, but we are suffering from those sanctions. We are paying twice the petrol, and then we had to buy gas from the United States. What a coincidence! And I stop here. See this, which is the effect at the very end of the story. The system does collapse. So the regulation said negative externalities affecting firms and households when something goes wrong, and that was the best example. That has been the best example for 20 years. But now I think that we'll have, in a few weeks, months, we'll have more examples of how things can go wrong. When something goes wrong, uh, it's, uh, it's easier to understand why we need for regulation. And regulation means costs and benefits. Although regulation may be beneficial, it also imposes private costs on individual financial institutions, owners, so the shareholders, and management. And we have 6 types of regulation. I want just to introduce that today. The ones that we saw before. Safety and soundness, monetary policy regulation, credit allocation, consumer protection, investor protection, and entry and chartering regulation. So safety and soundness regulation, such kind of regulation aims, as you can imagine, of course, to incentivize banks to diversify their portfolio, so that that portfolio would be, the risk of that portfolio would be lower. So trying to maximize the number of black houses, say, looking at the example before, no red houses. And concretely, for instance, they are not allowed to make loans exceeding 15% of their own equity to a single company. To fix a minimum capital requirement they had to keep over time, the capital adequacy regime. To establish a provision of guarantee funds in case of default, like deposit insurance. You know what is deposit insurance? Usually deposits until $100,000 or euros are protected by the schemes. To establish an effective monitoring system, so which means you are in charge of monitoring borrowers, please do that. So regulation is aimed to make it concrete, by also by surveilling what they do, banks now, not borrowers, what they do, banks, in order to develop, to play their role of monitors. So diversification of assets, minimum capital requirements and other regulations. TARP, you see in a minute, and capital purchase program, guarantee funds, deposit insurance. And Securities Investors Protection Corporation. So here in the slide, you'll find also the links to have a look to what they are and what they do, these companies. And the Troubled Asset Relief Program, so TARP, is a program of the United States government to take off toxic assets and equity from financial institutions in order to strengthen the financial sectors, and it was passed by Congress and signed by George Bush. In 2008. And you also, you'll find in your textbook, which is an American textbook, even if international edition, you'll find a series of reference to the United States regulation. It's interesting indeed. You have to go through. But we are first interested in the consequences of the premises and the consequence of crisis. So, which are the authorities in charge? Which are the crucial Grundnorms, crucial regulations in the United States, and so on and so on. Second, monetary policy regulation. Such kind of regulation aims to regulate the whole amount of money in the economy. Outside money, what I call the monetary basis, or sometimes high potential money, the outside money, and inside money, which is the money by the banks. The money, the inside money, the banks deliver to the market through the multiplier mechanism, and you know what is it. Banks are required to keep cash, a quota share of their liquidity to face short-term needs, so against the liquidity risk, which is one of the risks that we saw in the past. And you know the story, how it works, the LM, we saw at least 2 or 3 times how is that the central bank can regulate the money according to the preference for that money, and how it can impact the equilibrium. Credit allocation regulation, I already spent a few words on that. Such kind of regulation, in fact, aims to support socially important sectors like housing and farming. So it consists usually in reserving minimum amounts of the available loans for very specific sectors, the ones to be pushed, to be favored. So qualified thrift lender test. So they are, again, they are references to the United States system. They are examples of what we said now. So the facilities granted to some sectors. The disappearing explanation again. That's a mystery. Why? Where is it? Here. Okay, so qualified thrift lender test. In order to meet QTL test, 65% or more of bank's portfolio assets must be qualified, and qualified, to be qualified, you know, according to the Homeowners Loan Act, blah, blah, blah. It serves to boost that sector. Consumer protection regulation. This kind of regulation aims to avoid any kind of discrimination in lending. The Disclosure Act is an example, and the Community Reinvestment Act. You'll find in your textbook some details on them. And that's matter of course of granting equal access to loans, so no discrimination. a new Consumer Financial Protection Bureau to protect consumers was passed by the Congress in 2010. You see, many of these regulations, they came after the crisis, of course. Investor protection, to protect investors using the investment banks to purchase securities. So aim to protect investors against the abuses such as the insider trading, lack of disclosure, fees and breach of fiduciary responsibilities, and so on. The K legislation, Security Acts on 1933, 34, and the latest, the Wall Street Reform and Consumer Protection 2010. And 6, entry and chartering regulation. This kind of regulation is to fix barriers to entry and regulations by restricting the list of individuals who can establish financial intermediaries and the set of financial activities permitted. So not everybody can establish a bank, of course. You need an authorization to establish a bank, not just in the United States, but everywhere. And you have to face a well identified and well-known and clear set of requirements, and to guarantee, for instance, that the proponents have not to be criminals, have not to be had to be enough solvent. They had to guarantee a huge portion of the capital at the beginning, and blah blah, and they had to perform a study, a relation at the beginning, where they do explain the reasons and why, and intentions and investment and planned sectors where they are going to invest, and to lend law to grant loans, and so on and so on. So I will stop here for today and for this week. Thank you very much for your attention, and see you on Tuesday, next week. And please, in the meantime, if you can arrange the groups, and at least tell me how many groups we have and how many people, because it's needed to go on. Thank you.